If you're thinking Australia's new 3 million super tax won't impact you, I urge you to think again. I'm seeing a lot of people ignore this news because they've mistakenly assumed it only impacts the ultra rich. But even if your super balance is nowhere near $3 million, I promise you, this change will eventually impact you. My name is Davie and I'm a chartered accountant, and in this video, I'm going to show you exactly why this new tax isn't just a political headline, but a real practical issue that could affect your future. More importantly, what tangible strategies you can implement right now to safeguard your retirement. First, let's clarify what this tax actually is. From the start of 2025 to 2026 financial year, the Australian government plans to introduce a new superannuation tax targeting people with balances over $3 million. The tax rate on these amounts will effectively double from the current 15% to 30%. Sounds simple, right? But the tax doesn't just apply to money you've actually earned. It applies to unrealized gains, and it's why everyone is so upset about it, even me. You see, traditionally, taxes are paid on realized gains, meaning profits from assets you've actually sold. So if you own a property and you sell it, whatever gain or profit you make on it is usually subject to capital gains tax. The key here is that the capital gains tax obligations are only triggered when you sell the property and the cash is in. Now, with these new rules, you'll be taxed not just on the actual profits you've received, but also on the increases in the value of your super assets that haven't been sold or turned into cash, which is unrealized gains. In other words, you could owe taxes on gains that exist only on paper, like your shares or property increasing in value, even if you haven't sold them and you haven't received any income from them at all. That's like being taxed on the increased value of your house, even though you haven't even sold it and might never actually sell. The second big issue is that this $3 million threshold is not indexed for inflation. $3 million might sound huge today, but with inflation and rising property prices, millions of Australians could eventually be caught by this tax, even though their purchasing power isn't necessarily higher. I'll give you an example. Let's say you're 45 years old today and you've got a super balance of $1.5 million. Your goal is to retire at 65, so that's 20 years from now. If your super grows at an average annual return of just over 6%, your balance will double by the time you reach retirement, putting you right at the 3 million mark. Now, here's the issue. That $3 million would not go as far in 2045 as it does today. If inflation averages 2.5% per year, the purchasing power of $3 million in 2045 would be equivalent to about $1.86 million in today's dollars. So you're not actually richer. You haven't gained more real-world spending power, but under the current rules, you'll still be taxed as if you had. And that's the core problem. The threshold doesn't rise with inflation, but the cost of living and the assets values will, meaning more and more Australians could be hit by this tax over time, and not because they're the ultra rich or wealthy, but simply because they've saved diligently in a rising economy. So I have some thoughts about these changes. First, on unrealized gains policy, taxing paper gains means people could be liable for tax even though they haven't accessed or realized their funds. This is going to be a massive problem for SMSFs or property heavy portfolios where assets can't be easily sold down. On top of that, there's administrative burden. Calculating unrealized gains each year requires valuing every asset in your super fund, including illiquid and non-publicly traded assets like property and private equity. That's not just time consuming, it can be very expensive. These valuations aren't free and someone has to bear the costs. And in most cases, that cost will fall back on the individual taxpayer, and that's you. Further reducing the retirement savings this system was meant to protect. Also, markets fluctuate. A person's super balance may exceed $3 million one year, triggering tax on notional earnings, and fall below it the next year, creating a system where tax liabilities swing based on temporary market conditions, not actual economic benefit. Second, not indexing the 3 million threshold essentially punishes long-term savers. Australians who are younger today and saving diligently could be unfairly penalized simply because their balance grew with inflation. The policy policy effectively guarantees that more middle-income Australians will be pushed into the extra tax rate over time, not due to excessive wealth, but due to inflation and rising asset prices, especially property. And in my opinion, all of this essentially undermines the trust in the superannuation and tax system in general. Using a flat dollar cap rather than income-based or tiered thresholds makes the policy one size fits all. It doesn't consider personal circumstances, like whether someone has their entire savings in super with no other assets or incomes elsewhere. If the goal is to limit excessive tax concessions for ultra high balances, there are simpler, fairer, and internationally aligned mechanisms that could achieve that same result without undermining the credibility and stability of the super system. For example, instead of taxing balances, limit the concessional tax treatment on earnings beyond a certain amount. For example, the first $100,000 of income is taxed at 15% and the rest is taxed at the marginal rate instead. Or introduce a tiered tax system. Just like how personal income tax works, they can introduce progressively higher rates on higher amounts, or they can allow for deductions for inflation index growth. And if they choose to retain the 3 million threshold, it must be adjusted annually based on CPI or wage growth to maintain a fairness over time. Also, why does it have to be on unrealized gains? That's just not a good idea at all and should not be applied. But I'm sure you're more concerned about what you can do about it right now. And if you're nowhere near a 3 million super balance today, you might feel like this doesn't apply to you. But that's exactly why it's important to pay attention. Because if you're in your 30s, 40s, or even 50s, the combination of compounding returns and inflation means you could end up crossing that line without even doing anything differently. Here are 5 things worth considering. First, start tracking your super balance more actively. This tax is triggered by your total super balance across all funds, not just one account. That includes your main super fund, any old or inactive accounts, or even your SMSF if you have one. It's worth consolidating accounts and understanding where you sit today and where you're heading based on your current growth rate. Second, run projections. Use your superannuation calculators to model what your super balance could look like in 10 to 20 or even 30 years based on different return rates. You might be surprised how quickly compounding takes you closer to the cap. Awareness here helps you plan ahead instead of being blindsided later on. Third, think strategically about where you invest new money. If you're likely to cross the threshold in the future, it may make sense to diversify outside of super. For example, using family trusts, bucket companies, or other tax structures for investment purposes. You can also contribute more funds to your spouse's super instead to help keep both of you under the cap. Super is still incredibly tax effective, but this rule may shift the balance for some people, especially those nearing the cap. Fourth, keep an eye on policy changes. This rule is already controversial. There's political pressure from multiple sides, industry groups, accounting bodies, and even within the parliament. It may evolve before it's implemented, especially if it proves unworkable or unpopular, which it is right now. So don't panic, but stay informed. And lastly, talk to your advisor early. This is one of those situations where getting tailored advice before you hit the threshold can save you money, stress, and taxes. A good advisor can help you map out a strategy, whether that's contribution limits, asset allocations inside super versus outside super, or timing withdrawals. At the end of the day, the best defense against uncertainty is knowledge and preparation. Take control of your future, your retirement, and your wealth. I'll see you in the next one. Cheers.